All right, the Federal Reserve raised short-term interest rates by half a percentage point to its highest level in 15 years. This move, an indication that the fight against inflation is not yet over. Let's bring in Yahoo Finance Fed correspondent Jen Schonberger. Jen, saw you in there in the media section yesterday. Got your question. What are some of your takeaways?
Good morning to you, Ryan. Yeah, that's right. The Federal Reserve slowing down the pace of rate hikes, raising its benchmark interest rate by half a percentage point to the highest level since December 2007. That brings the Fed funds rate up to a range of 4.25% to 4.5%. Officials raised their estimates for the peak of their short-term rate by 50 basis points to 5.1%. That's about 25 basis points higher than what the market was expecting. And that's just the median. 7 officials see rates moving higher than that 5.1% level, with 5 projecting rates could move as high as 5.25%, and 2 projecting rates could move as high as 5.6%. Fed Chair Powell struck a hawkish tone in the press conference, saying that the committee is not at a sufficiently restrictive policy stance yet, and that it's possible officials could raise estimates for rates even higher if inflation continues to be sticky. Take a listen.
I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data.
Powell said inflation data in October and November pointing to that cooler CPI numbers are a welcome reduction, but that it will take substantially more evidence to gain confidence inflation is on a sustained downward path. Powell said he wouldn't see the Fed considering cutting rates unless the central bank is confident inflation is coming down. The Fed chair noted that reducing inflation will likely require a sustained period of below-trend growth. The Fed lowered its growth forecast. It now expects just 0.5% of growth next year and about 1.6% in 2024. December's moves cap an historic year for the Fed that saw the central bank raise rates at the fastest pace since the 1980s to tame stubborn inflation that reached a 4-decade high. After holding rates at near zero since the beginning of the pandemic, the Fed moved in March to raise rates, ultimately raising rates by 4.25 percentage points this year, including an unprecedented 4 75 basis point hikes in a row. Fed Chair Powell's commitment to, quote, keep at it until the job is done earned him comparisons to former Fed Chair Paul Volcker. Powell repeatedly reinforced that the Fed's resolve to quell inflation wouldn't be without pain. Now, next year will bring continued rate hikes, though at a slower pace. Powell did not tip his hand, of course, as to whether the Fed would slow down the pace of rate hikes even further to 25 basis points at its February meeting. Back to you.
Jen, of course, it's not only the U.S. Central Bank that has been busy in the past 24 hours. We heard from the ECB, the Bank of England, a lot of tightening out there.
Yeah, Julie, absolutely. Inflation is very much a global story, and both the Bank of England and the European Central Bank sort of mirroring the Federal Reserve's moves, raising their benchmark interest rates by 0.5 percentage point and stepping down just as the Fed did. They, too, have a balancing act of trying to cool inflation while also making sure that they're not crashing their economies, as there are signs of slowing economic growth over there as well.
Thanks, Jen. Appreciate it.